Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything that you need to start your trading day. Good morning, everybody. Welcome to this Wednesday pre-market prep. Spencer Israel, Joel Elconin, Dennis Dick. Well, that was an interesting reversal of trend yesterday. What had been hot was not, and what was not hot got hot again. Tech staged a comeback. Goodbye, energy and banks for now. It was all about tech yesterday. All about GameStop here this morning. The stock is back up, almost got to $300 this morning. Not quite, though. We're going to talk about that. GE. Haven't talked GE too much besides just technicals, but GE has news, real, actual news this morning. We're going to talk about that. Don't forget the Roblox IPO is today. It is going to be the largest IPO of the year to date. It's a direct listing, so that'll probably open sometime around noon, I would guess. Two guests on our radar today. First up is Paul Mladjenovic. He is the author of Stock Investing for Dummies and The Raving Capitalist. He'll be on at 8:35, and at 9, we've got Putnam, who is the chief economist at the CME Group, to break down all these crazy macro developments for us. So full show today. Let's bring Joel on. Oh, also smash that like button, guys. Let's get some more likes than we got yesterday. Thank you very much. Joel, how are we doing this morning?
We're basically flat. Nice range overnight. We're up just a buck at 74.25. This is the last day where March will be your front month contract. So expect some choppy waters today. Pre-market high, don't have anything up there at 83.25. Pre-market low, a little bit of significance there. The pre-market low is 56.25. Tuesday's interday low, folks. That's from 9:30 to 4:15. That was 55.25. So that's an interesting level. Crude, that's up 60 cents at 64.61. Gold in the red, but still above 1,700. That's down 640 at 17.10.50. Silver loses 26 bucks. That's down 34 cents at 25.84. And Bitcoin working its way through the 55 handle, $55,735. That's up $1,000, just about $1,000, and that is the futures. Triple D. I don't know where we want to start here. I will say that this GE news is pretty interesting.
Reverse split?
Yeah.
Well, they're doing a deal too, right? Give us all the news here, Mr. Israel.
All right, so it's a spin-off. AerCap, ticker AER, is going to acquire GE Capital Aviation Services. So GE is going to get some money as a result of that. They also issued some new guidance as a result of the transaction. And they also said that the board recommends, this was not official, but the board recommends a 1-for-8 reverse stock split, which I can't remember the last time a company did a reverse split and they weren't in like a death spiral, right?
Yeah, because once they go under a buck, the exchanges start to obviously want to delist you when you're under $1. Yeah. So that's why they do the reverse splits, to get back in compliance there. So this is just doing a reverse split because they want their stock price higher. They want a higher stock price. Obviously, if you own 800 shares, you're going to have 100 shares after the reverse split. So it's not free money at all. Usually stocks go down on reverse splits because people don't like it that you're taking shares away from them. It is actually falling here now, and the pre-market was way up earlier, but maybe some people read the book on what usually happens during reverse splits, and the stocks usually go down. I kind of like it. I mean, I like trading GE at $13. I think I'd like trading GE at $100 too, though. So as a trader, I kind of like the idea of GE being a $100 stock again. As an investor, I don't. But I'm not an investor. So.
But you're a trader, so you do.
Yeah, so I kind of like it.
Financial engineering.
But this is financial engineering in a bad way, really.
But
like usually what happens, the stock's reverse split, the stock price pops up and then it just starts to leak. And it leaks and it leaks and it leaks and it leaks. Because it's just a higher price for more people. I don't know why they do that, but they just tend to do that. When they reverse split, they tend to leak after the reverse splits. So
you see Groupon?
no, it's Groupon doing. I haven't even looked. That thing's just been a monster.
Yeah,
but we talked about it last week though, but obviously had an ugly day. Is there news on it? Why bring it up Groupon today?
because they did a reverse split.
Yeah, but when was it?
That was a long time ago.
That was like years ago, a couple years ago, right?
Yeah. I mean, the whole business of Groupon obviously was COVID, got hammered. You can really see very pronounced the reopening trade in Groupon because, you got restaurants, they're selling, nobody's doing anything. I mean, Groupon was ground zero for this. So you can clearly see, obviously it went from $58 to $10, during COVID because nobody's going to need a Groupon ever again. I mean, we're reopening.
It was, I'm sorry. It was last February, and it was a 1 for... it was basically a 1 for 11 is what they did.
Yeah.
I think it's.
I'm sorry. It was 1 for 20. It was 1 for 20. Stand corrected.
Never thought GE would stoop to that level, but they are. They want $100 stock. They want it to move.
They'll have it for a day maybe, and then it'll start to leak. So, as an investor, I would not be buying it on this news. Like I said, they tend to leak ahead of those because people don't like getting their shares taken away. You made 100 shares, you're going to have 100 shares after this. People don't like them. They don't like. They like regular splits where they're getting more shares. They hate reverse splits because they're losing shares. So it's theoretically it's supposed to go up as much as the reverse split. They never seem to go up as much either. So I mean, from a shareholder perspective, I wouldn't want to own GE for a reverse split. If you're jumping in saying, "Oh yeah, reverse split, cool," not cool. At least textbook. And from a trading 21 years experience, it's not cool. So whoever's buying this, like, where did it get to this morning? Was it 1450 or something?
Got over 1450, yeah.
Where did we get? Show the chart. I don't like looking at my mugshot all day. What's the chart look like?
I don't know. Spencer took it away.
What do you mean you don't know? Who's got the charts? We don't have any charts.
I'm sharing.
No, we don't have any charts.
Where'd Spencer go? Spencer?
I don't know. I'm here. I'm just fixing your audio on all this year. So I'm here, but I'm not here.
We got the charts. 1450 this morning. Somebody didn't read the textbook on reverse splits. They were reading it now, and they're like, "Oh, this doesn't go up on this?" No, they don't usually go up on reverse splits. So, rightfully punished whoever bought it up over 14 this morning. Stock coming in. I know, but rightfully punished whoever's buying that this morning.
1452 is where it got to. And what was yesterday's high? 1442. So if you were using yesterday's high, there's probably like a boatload of stock at 1450 since it hasn't been there since early 2018. We'll see. I mean, we're bearing down on a pair of lows from 1380. That's my level of the day. GE. Yesterday's low 83 to 2-day low 81. If not, look out below. Major support at the $13 area. I don't have anything else. Do we have a close in between there? No. 1360 was your close on, what's today, Wednesday?
It's an important day for it. How does the market, and again, remember one thing, this is an official announcement. So if you see the stock get hammered, maybe the board will have a second thought. So you could see the stock go weakness, and they'll be like, maybe we won't do that. This is, something, it's like a feel, they could be feeling it out there too. So seeing what the market's taste for it is by saying board recommends as opposed to, oh yeah, we're doing a reverse split. So it's actually not official yet.
It's right. But
what is official, Joel? Or did you have another thought on G before I take it away?
Take it away.
What is official is GameStop is just a monster. A monster stock. We liked it 3 days ago at 140. I'm like, it was setting up well. You could see it didn't want to go down. It felt like it wanted to go up. I'm actually kicking myself. I couldn't stomach buying it because it was just, it's silly town. And you just don't know, it doesn't make any sense. But at the same time, the technicals, if you could just ignore all the fundamentals, which the market is completely doing, the technicals were setting up really well. And we've rallied, we've doubled in 3 days since we liked it on this show 3 days ago. So congratulations to whoever bought. I know there was a couple followers that bought it that day. $281 here now. This is incredible. Where this ride ends, nobody will know. I mean, I've never really seen the bag holders get bailed out. again and again and again, but they appear to be the case. Could this hit a new all-time high? It is possible. It can do anything. It could pull the rug out from under. It is now in the middle of nowhere officially. I would say 300 is a big psychological level. Couldn't get through there this morning. Does it get through there today, intraday? The stock can go anywhere it wants because it's completely disconnected from fundamentals. The efficient market hypothesis, you can throw that and fire it into the sun because it is officially wrong. I buried it last time GameStop was going up. I'm burying it officially. The efficient market hypothesis that says stocks are always pricing in all fundamental and information that's out there. It's nonsense. It's complete nonsense. It always was, but this is proving that it's complete nonsense. So this can go wherever it wants. Fundamentals are meaningless. I mean, if we're buying and paying $1 million or $2 million for digital art, why not pay whatever the hell we're paying for GameStop? I mean, this is just loony. Everything is just crazy. Oh yeah, I'll buy a video of an NBA player doing a slam dunk and I'll pay a ridiculous amount, or I'll buy Dorsey's original first Twitter because somebody else might buy more. Somebody else might pay more. This is what bubbles are built on. They're built on stupidity, and this is more stupidity as well. But I'm not going to argue with it. I'm not going to short it. This can go anywhere it wants, anywhere.
But you know what Joel I think Joel's going to say now is at least GME has some price memory here, right? It's been here before.
We have technicals. We have technicals
that's
to
why
follow.
I liked it.
That's why we both liked it.
We
both liked it on this show 2 days ago. $140.
When was Kenny on? Kenny on was on last Thursday, right?
Did Kenny like it?
Yeah. It was
me and Kenny we were on opposite sides, and it was last Thursday. He was on the afternoon show.
Yeah, it was Thursday.
And what I was looking at was higher lows.
Yeah.
I mean,
that looked good.
I mean, it's like simple technical analysis. And you're on a streak here. 1, 2, 3, 4, 5, 6, 7 higher lows in a row. What do you need? You don't need to get kicked aside the head. It looked like we're going to have another higher low today.
If you're shorting this and coming in and saying it's stupid, it's crazy move, man, because, you're right. It's dumb. But this is the poster child for market can stay irrational much longer than you can stay solvent. Just ask Melvin Capital. So, I mean, this is literally the poster child for that saying. So it can do whatever.
Do we have anybody? I know we had some people that bought it and didn't get out of it. And I know they were.
I would get out if I was in it just because it's GameStop. And, eventually it ends in tears. But, I mean, I thought it was already over. A few weeks ago, and then obviously we got the next kickstart. And then we're like, well, it's going to go again. So I don't know. Does it kickstart all the short squeeze stocks again? Probably.
That's what
it's worth noting that AMC also reports tonight. So there's going to be some fundamental news out. Not that matters.
Tonight they reported.
How can it be a good report? No one's going to movies. I don't understand.
And I'm kicking myself because Express reported here this morning, and we can take this over. But I actually thought this. I was like, they'll just find a reason to buy Express because GameStop's going. They will care nothing about the report. They'll rip Express higher just because it's the short squeeze. It's one of those like 5 big names that they've been running, and it's up here this morning. I was like, why did I not buy that ahead of the report? I just got the guts, buy it ahead of the report because they're probably going to find a reason to rip it, and they do. It's up 25%. What were the numbers? They don't matter, but what were the numbers?
No, they lost 66 cents per share last quarter. This is EXPR.
Yeah.
That was 20 cents better than the estimate. So whoop-de-doo. Sales
burning cash like crazy. Companies in shambles, but doesn't matter.
Yeah, their sales. They beat their sales estimate by $6 million. So. Good. 430 versus 424 million. But again, mall-based retail, that whole group, Express, A&F, AEO, right? All those mall-based retailers that kind of move together.
You can't get short any of these stocks that they've been talking about on Reddit. If you're short these stocks that are on Reddit, you're asking for a lot of trouble because these things can just go. Is it Reddit driving it? I think Reddit just keeps the party, like the fire going, like they throw a log on the fire every once in a while. This is hedge fund action. This is just, squeezing. This is just doing other things. This is, being driven by major players. This isn't being driven by just retail. This is being driven by a lot of other major players as well. So we've been talking about that. But, Reddit keeps the fire going. And the hedge funds are like, yeah, we'll party, man. We'll buy this thing up and squeeze a few people, make this, make the markets go nuts. We'll do it. So,
It will.
so
Boy,
yeah, so you know the list: GameStop and AMC and Express and Bed Bath and Beyond was part of it before. I don't know if
Oh,
they're going to get
wow.
started again. They came off a little bit there, but it could get started again. I mean, there's a list of like 30 or 40 of them. That short squeeze site, what was the name of the site you could go to? highshortinterest.com. Yeah, highshortinterest.com.
That's the one.
Yeah, they're all there. That's the names that Reddit was all picking on when, you know, the GameStop party. So, you know, those are the names. I would not want to be short any of those names.
GameStop came halfway back. It's actually, I just figured the exact number because my 261 is halfway from that 483 high down to that 3850 low. And my numbers, like I said, my numbers are off a little bit, but 261.
There you go. 50% retracement. Shows finding the fib for you.
Yeah, there it is.
Cost another one too. KOSS, I forgot about. Yeah, that one got crazy just like a week and a half ago, and now it's going to get crazy here again. So it's up 60. No, it's up 40. It was up 60%. It's up 43% here now.
How about BlackBerry?
What about Muriel Siebert?
Oh yeah, BlackBerry. You know what,
Joel? Enough with that one. Okay.
BlackBerry. You know what, BlackBerry. It got off the mat here, so why not? Why not? It's up 4% here this morning. I mean, it's hard to just. The problem is, the GameStop turns around, starts tanking, then they'll hit these ones too. So I don't expect BlackBerry to go to $25. I don't think it's going to happen. Could it go to 12? 13? It could. It's at least, you know, it's stopped going down. Had a good day yesterday with the rest of tech. Above 10, as long as it stays above 10, sure. I think it's okay. I don't own it. It doesn't look bad though above 10.
So for all these other names, BlackBerry, Express, anything, GameStop is going to be your tell, right?
Yeah.
As GameStop moves, so will they.
Yeah, I don't think just because GameStop went up 30%, this one's going up 30%. It's a lot smaller moves than the other ones. And if GameStop all of a sudden turns around and starts going red, they'll hammer all these things too, despite them not already having the move. So you got to be careful with these things. GameStop, correct, is your indicator though.
What about Rocket?
I mean, that could go too. That could go. It could. I mean, it's come back in a long ways. So it's got the potential. They're not really doing much with it this morning. It's kind of just hung out here for a couple days, but it stopped going down. I don't mind it. I was sitting down at 21. I wanted it at 21. I don't think I'm going to get 21. I don't think I'm going to get 21.
No, not anymore.
Someone said, Spencer, bust out Mama's money.
Because
he bought BlackBerry.
No. Yeah,
I do have a day trading position in Rocket, just a day trading.
Okay, okay. We won't move on. Yeah, let me know when your mom gets long the BlackBerry there.
Yeah, no, I don't want to deal with that again.
All right.
Okay, let's move away from all these meme stocks and let's talk. I don't know. There's a lot of different stocks.
Let's just talk.
Yeah, let's talk the rally. I mean, the bounce back, the snapback, the so impressive the rally yesterday.
Oh wait, Dennis, before we do that, what about your market theory? You know, GameStop up, market down. Are you going to get
that? Didn't work yesterday. Maybe it's officially broken now. GameStop was up. The market didn't care. Everything. Well, not everything. That was a wicked rotation day, though. There was so many stocks that were way down yesterday. The Dow was barely up. It might have even closed red. But tech, they were just buying tech, hands over fist, and selling everything else. Again, who does that? Like, who's coming in and buying up Tesla $100? You know, who's saying it's going up 200? I don't get it. I mean, if I was long Tesla and you had the guts to, you know, we knew it was oversold. We talked about tech being oversold. You bought it at 600. Who's coming in and buying it at 680 and 690? They think it's going straight back to 800 in this market. I think you're on the wrong side. Like, it's buy the dips, sell the rip. Don't buy the rips. But people do it. A lot of people are doing it. It doesn't seem to work as well as buy the dip. So, nice snapback rally.
Yeah, I wonder if it was my article.
What'd you put in your article?
When I put an article, it was like, what happens if Tesla takes out 540? But I said if.
Oh, yeah. Then it went the other way.
And it went the other way. So I think people are like, "Oh man, we're gonna burn Joel on this article," and they just
That's
and they
Reddit people
did. I
got a
did
hold
because
of
I
you.
got some
They're gonna
people
burn.
were like, "LOL," and I put at the bottom of the article that I'm long. I just wrote it. It was just a setup. All I was doing was talking about a setup. What if it took out 540? It got this 560. If anything, I was saying, hey, take a shot here and lean on 540. I don't know what
That's
happens.
what I liked was I was trying to lean on some of those lows. That's why with Marvel, I bought a few. I didn't go into Tesla because again, valuations. But I was like, on Marvel, I had a level to lean on. I was like, okay, I'm going to ignore the big cut through 37.92. But I was like looking at the previous day's low at 40, 39.89. I was like, well, maybe it bounces at 40 again. And I picked it up just above 40. Rarely do I buy almost the low of the day. This was on the 8th, but I did. And obviously, for 2 days, it's ripped higher. But if this was a trade, you'd think, okay, well, 40 to 45 in a day is a pretty good trade. Just like Tesla. If you were lucky to buy it under 600 and it rips up to 680 in one day, what do? You take the money and run. That's what I say you do. So I ring the register when you get those, wicked, pops there, and and you've had it on just for a trade. You can sit around and be greedy, but again, this market has given back. We're still in the yo-yo market. The title of the show 2 days ago, yo-yo market.
Yesterday.
So we are bouncing around here a lot still. Is there another big down day to happen in the stocks? I think so. I think it's going to be there again in the tech stocks. I don't think we're out of the woods. Is Kathy going to go straight up from here, ARKK, and just buy the hell out of it? I would lean on those lows on the move, but I'm not paying up a 122. Comes back 116, 117. You want to take a shot, buying the dip if we get another dip, which we probably will.
Chris Brown and people is asking, where do you find my articles? And I every day I do the pre-market prep stock of the day. And
you can go to benzinga.com. I'll just put a link. You can find all Joel's articles. How about that?
Yeah, that's good.
Special.
Yeah, every day. Sometimes it's something we talk. Yeah,
you can find every article ever published under Joel's name at Benzinga.
I haven't written a sports article
on this link I'm about to put in chat. There it is. There's the link.
You know what I am?
Joel link.
Joel's archives.
You know what I am scouting out though, and Nick Bellucci will be happy about this. I've been watching the Derby preps. The Derby prep.
When is the Derby?
First Saturday in May.
It's coming.
Yeah. Yep.
Who's the horse? You haven't picked it yet?
Now there's one horse that they haven't run the big Derby preps yet.
Yeah,
but,
so not enough information yet.
Not enough information, but I got a little. I've been watching them on the weekends, and I think there's a horse that won the Gotham. It's not a big stake. I think it's Grant Honor or something like that. He came from way behind, but we're gonna have to watch more of the Derby preps. There hasn't been the Florida Derby. There hasn't been the big ones yet. But it wasn't the Gotham. I can't remember what race it was. It was Race of Florida, and this horse, Grant Honor, I think is the name of it. That's my early favorite. But hey, we still got over a month away. Back to the markets. Hey, Dennis, 8:30 Feb CPI. Everyone's worried about inflation.
I got to go wide.
What do you think?
You probably got to be careful on this and economic numbers. They haven't mattered for a long time, but they are starting to matter here now because you're right. People are looking at rates, people are looking at inflation, and they're looking for leads. We hadn't been looking at the bond market forever, and then the bonds, obviously became the leader here. All of a sudden, people decided to start looking at it. TLT had been going down for a month, and nobody paid any attention whatsoever. But all of a sudden, it has a bigger down day, and everybody's like, rates! So, anyways, that's the way this market does. It doesn't notice things until somebody points it out for them on CNBC. It's literally the dumbest market ever. But okay, let's continue.
You got to get that one.
I'm getting that one. That was
what
good.
was that, Dennis? I don't think you can. I don't think
good.
you can repeat that noise that you.
What is Bitcoin's story? They're all talking riot. Bitcoin did not sell off with the tech wreck, though. You would think like Bitcoin would get hit with all the Momo stuff, and it really didn't. And now we're starting to get. What's the all-time high in Bitcoin? We're not far. We're not far.
On the futures, yeah.
Whatever. I don't know because it's quoted on like a bazillion places. But what's the roundabout all-time high? We're not far.
50, 58. What's this high right here? I thought it was in the
59?
57.
We never hit 60 then.
58, 470 on the 22nd.
58. Okay, and where are we at?
Yeah.
56 this morning? We're right there.
Yeah.
So yeah,
Yep.
because people talking the riots and the Mara, I mean, they've been hammered with Momo, but the nice snapback rallies here in all these the last couple days. I'd be a seller into this on these plays, but I mean, good on you if you guys are buying
down. I mean, it's just
Bitcoin's holding up well. What about the laggard of it's been BT? It really got hit hard. Like, I mean, from 30 to like 11 in a week and a half. And now it's all of a sudden, back up at 17. So it's kind of bounced. But, you want the list of them. There's Riot, there's Mara, there's BT. There's some smaller plays in there too, which, I can't even remember them all here now.
Ooh, look at that. There's an interesting level. Let's see if it for
MSTR is the big one too, right?
Oh,
like
is that come back?
MicroStrategy, yeah, that really bounces around. That thing ripped to 1,300 and then it got cut, by 60%. Now it's showing some life here again too. So,
let's see here. We're trading. Wow, we're trading up here. I see 56. Look at all these highs around 50. I keep an eye on 57 today. That looks like a big level. If it blows through there, things open up. I see a couple highs. Let's see how high it got in the pre-market. Boom. Jeremy gave me some levels to keep an eye on in Bitcoin. Try and buy it on a pullback, but man,
if it takes out that 60,000, that's the big level. Can it take out the 58 and make new highs, or does it stall out there? That's the question to be answered here. Important question. Full disclosure: I'm still long Bitcoin.
Yep, GBTC.
You got GBTC?
No, I'm just saying.
Yeah, I'm a Canadian. I've got two of them. I can't remember the symbols of them either, and I think it's. I got two of them. I got the ETF one, and then I also have the other one too. So I have two.
I read there was an interesting piece yesterday from Dave Nadig, who is the head of what is he? He's like the CIO, director of research at ETF Trends. Wrote a whole thing about GBTC and basically how it's the ultimate diamond hands play because GBTC can literally never sell their Bitcoin, like it's trapped in GBTC. It was a very interesting piece.
Trapped?
He ran into this whole thing basically just like the way the nature of the structure of the trust. They basically can't sell it. I'm going to do a bad job of explaining it. So rather than me explaining,
I'd love to hear the reason. I didn't know they can't sell it.
I'm just going to put the link to this article in chat.
I'm going to read that,
and y'all can see what very interesting, interesting rabbit hole. You can call it a rabbit hole. Interesting rabbit hole into the inner workings of GBTC. This is from Dave Nadig, who is a great follow on ETF Twitter. It is 8:29.
Yeah, let's see what happens here.
Wide.
Go wide. Go wide.
All right, whatever. Should I just hold the orders in there and get picked off? Sold. It goes one way or the other.
Yeah.
As the algos pick you off, you're sitting there, with a 5 points looking, and the speeds rip 20 on you. And you're like, ow. This is called getting picked off. Adverse selection risk. Here we go, 8:30. I'm ready to cancel all the orders.
Little pop.
We went wide. We're 35 cents wide on SPY. 40 cents wide on SPY. Okay, we're trying.
Where's the number?
All right, that's good enough for me to cancel. I canceled all my orders. Didn't get picked off on anything. They're slow today. All right, next.
You're the only person that can lose money and laugh.
I had my first losing day of the year in my break trading account.
Here we go. In line, 1.7%. There. I'm sorry. I read the wrong number.
Is Bob going to shut you down?
Yeah, maybe. Yeah, it was a good streak I had going. Streak ended yesterday. I couldn't dig out of the hole that I got buried in off the hop. Buried in basically in the pre-market overnight. My overnights just were killing me. I had some bad overnights. Had some value long. Thought I'd hedge it with IWM, which has typically worked not bad. Did not work yesterday whatsoever. I got banks long down 2%, IWM up 2%. I was like, wow, this did not work at all. So anyway, so actually I have been on a good run. So that's just my bright trading account. Obviously my retirement account goes up and down with the market, but my main overnight day trading account, that was my first down day of the year. So it's been a good streak. It was a good run.
Yeah, I'm going long. We got a nice pop here. Very nice pop.
I'm glad
here.
I got out. I'm glad I
Yeah.
canceled my orders.
Yeah, look at that. We made it. We made a new pre-market high. The previous high was 83 and a quarter. We just got to 88 and a half. So they like it. Not worried about inflation. Like Pump and Powell, just not worried. CPI in line. Let's see what happens. Big number. The only number on the upside, 39.01 and a quarter. That was yesterday's high. So that's really what we have. I don't know. Yesterday I was calling for an inside day and they blew me out of the water. So I'm not gonna make any predictions today. But 39.01 and a quarter, that was the high from yesterday.
Are you guys interested in the IPO today, Roblox? It's going to be RBLX. It's a direct listing. It's got actually the first direct listing on the Nasdaq.
Nice.
All the previous ones, Slack and Spotify, were on the NYSE, but this one's going to be on the Nasdaq. So we have a reference price. Our reference price is $45. Again, this is direct listing, meaning they're not raising money. They're not issuing any new shares. They're just giving their current shareholders liquidity and allowing them to sell. $45 is going to be the reference price, which is kind of the same thing, in practice as the IPO price. It's going to serve as like a guideline for the stock today. But do you guys know what Roblox does? I'm just curious.
Nope.
I'm gonna take a stab.
It's very interesting. Sure, take a stab.
Is it maybe I'm totally wrong. No, I'm totally wrong.
Okay, it's basically like the best way to explain it. It's kind of like a social network for video games, and by that I mean it outsources game development, and the users on the platform, they make the content, they make the games. If you want to make Dennis Night, or I don't know, or Denny Night, or some game, Call of Dennis, you can make that on Roblox, and then people can play your game. Basically, it's a platform for you to make your own game, and then you get a cut of the revenue, and you split it with.
Let's make a pre-market prep game.
Pre-market prep game, exactly.
A stock trading game.
Exactly. So you can
have it like
the users make their own games and then play them on the platform. And so it's all user-generated content so it's basically just a platform for users to make their own. It's very interesting. It's very, very cool technology. So with Roblox IPO today, I'm watching the handful of esports ETFs that are going to have to buy them, I'm sure. ESPO, Hero, Nerd. ESPO, Hero, and Nerd are the three. Those are the three esports ETFs. So they're going to have to buy Roblox, and watching those today. It's going to be the largest IPO of the year. Remember, they're going to IPO back in December, right around the time that Airbnb came to market, and then that thing went like bananas. So they're like, well, hold on here. Let's wait and let's see if we can get a better price. Just to give you an idea, we were talking yesterday or the day before about valuations. The valuation of Roblox in September 2018 was $2.5 billion. Today, it's $30 billion. So it went from $2.5 billion to $30 billion.
We love
$29.5 billion in 1 year and 5 months. So
welcome to 2021, where we pay anything for growth.
Yep.
That's what it is.
Seems like you got to be.
And we buy digital art for millions of dollars because why not? There'll be somebody dumber after, I'm sure, to buy my digital art picture, or we'll buy Jack Dorsey's tweet that he didn't even spell Twitter right on.
This is. I know. Did you notice that too?
Yeah, he didn't even spell Twitter right.
Guys, that was intentional. Come on. And
either way,
and this is a better analogy from Bethy. It's more of like Minecraft. It's open source. Thank you. That's a much better analogy.
You got to be smart to use that thing, huh?
You got to be into gaming. Is what you got to do.
Nah, just me and Drake on Fortnite. That's about it. These guys are smart.
You're still kicking Drake's ass?
Yeah, he won't come on anymore.
He's scared of you. He won't go on the Peloton with you, and he won't play Fortnite with you anymore either.
Hey, you know what are we bringing in Paul?
Yeah, we finish your thought though.
Oh, I just want to say, first time in a long time, I did the 6 a.m. swim.
Oh, nice.
Yeah, Yep. So we're feeling good. I already got a 3 hours into the day. But anyways,
All
that
right.
was off topic. Let's bring in Paul.
Let's bring on Paul Mladjenovic. He's the author of Stock Investing for Dummies and the Raving Capitalist, which is like my favorite nickname ever. Paul, what's up? Good morning.
Oh, thank you for having me on. These are amazing times, so thank you again.
Let's see if we can adjust your mic.
Or adjust your volume a little bit. You're loud.
I'm gonna turn your mic down. Let's see if that works.
Well, I'm a public speaker. I'm always loud.
Oh, that's good. We like loud. We like loud. I'm usually loud as well.
Paul, what's been on your radar here? What have you been watching?
What's been on my radar? Well, when I'm dealing with my clients and students, I just think that this is, I don't know, maybe one of the most incredible markets of my life. I think it's overwrought, overpriced. I think there's a lot of the hazards out there. And for me, I'm more of a value investor, but I do have clients where I do speculating, and they've done. Last year was actually a great year for many of my clients. Among our speculations was, precious metal stocks and commodity venues, and so we're looking forward to a good year. But I do think that the most hazardous times are ahead of us, and so I think people have to be as exceptionally careful. But depends on what you're going to do. In terms of investing, I think value is more important now than it's ever been in my career. And for those of you who want to speculate, like market crashes and things of this nature, I think that the next 6, 12, 18, 24 months will offer some spectacular speculative opportunities there as well. So there's the long answer. So fire away.
You got any specific stocks you're looking at from a value perspective?
Hold on. Wait, try it again, Dennis. Ask it again.
I think you heard me. Do you have any value stocks that you're looking at specifically?
Well, a guy like me in a public venue, I always have to be careful when I'm making specific points. But I'm happy to. For some of my clients, I actually like Cisco because it has a good PE ratio. It has a good dividend. It's optionable, and it's part of the backbone of the internet. So I think it's a pretty good environment for stocks such as that. I love consumer staples, and I think that they're going to be an important part of people's long-term portfolio. So I definitely go there. I think precious metals, because I think it's going to be an inflationary environment and massive volatility coming. So I think precious metals-related investments, I think, will do well. So I think there's plenty, but they have to go by value going forward. And dividends, too. I love dividends.
So you're not loading up Bitcoin?
Oh no! Well, here's the thing. For a lot of my clients, obviously, Bitcoin is the newest kid on the block, and it's been overwrought. And I think that the downside is just as real as the upside. So for my clients, I tell them, go ahead. Part of a diversified approach is not just stocks and bonds, mutual funds, ETFs, gold and silver, but some Bitcoin too. I think that's fine. But for some of my clients who I'm more, circumspect about, I prefer like the blockchain stocks instead, because they're much cheaper to get involved with, and they're a great way to play it. Just like for some of my clients who ask me about Amazon, and I go, no, I'd rather go buy things that would benefit from Amazon, like packaging and things of this nature, because that also pays a good dividend, and it's a much more assured way to play things versus overpriced stock like Amazon.
All right. So I have a question. So Paul, you say you're a value investor, and that really hasn't worked for say for a couple of moments here and there. It really hasn't worked for quite some time. So how do you sort of navigate that, where you're all about the valuations and the PE and the price to sales and GARP, but growth has been the story for the last decade, and it was on steroids last year, the growth trade. So how do you, on the one hand, look at at valuations, and on the other, not just get insane FOMO when you're watching everyone else just chase and be rewarded for it?
Well, understand this about the value investing side. If you're investing in quality, most of my positions have been beating the market over the last 5-10 years. So I'm not that worried about that aspect of it. I just think that, there's a lot of people out there chasing stuff that's going to end up biting them tremendously. You know, a part of the value part is because let's face it, a good chunk of my clients are in pre-retirement. You know, does it make sense for them to be in some of these positions? Well, you know, again, I do take speculative positions. I bought call and put options that given me 500% gains, you know, but when I say value investing, I'm talking about, you know, for people where they're going to put 80% of their portfolio, you know, they have to be investing in the companies and looking at the fundamentals. I'm not worried about that they're not going to be doubling and tripling, you know, in the short term, like a lot of these, you know, glamour stocks and headline stocks, et cetera. I want them to be safe because I think that, you know, when the next, you know, market volatility hits and the pullbacks occur, you know, what's going to still be standing? You know, you're going to see, you know, a lot of pain in the market because it's definitely overwrought. You know, so.
So Paul, so how would you position for a downturn? Let's just say hypothetically, you know, we experienced something like we saw at the end of the dot-com bubble, where for like a couple of years there, the market just went down for a couple. It was like a long-term bear market. How would you position for that?
Well, first of all, keep in mind, I as I mentioned, to my small impact, I do have, you know, bearish positions out there and inverse things. And since you mentioned the dot-com days, you know, my among my biggest positions at the time were long-dated put options, you know, on many of the internet stocks. So for me, I was poised for those crashes. And then when the market came down, obviously in a market crash, whenever it's like a, you know, a generic or systemic crash, the good stuff comes down with the bad stuff.
Right.
So for me, when I cashed out all my speculative positions and sitting on those profits, now I was able to, you know, look at stocks and find phenomenal deals, and I was able to lock in, you know, for many of my clients, dividend yields that are twice what they are today. So going forward, I think that a small portion you should be considered, you know, bearish, because I think the market, you know, a crash similar to 2008 is sometime on the horizon, especially with the policies that they're unfolding now with the economy since January. So positioning now, yes, I would start accumulating like some inverse ETFs on the speculative side, and in addition, I'm also buying call options, you know, on a lot of things that I feel are going to benefit when some of these things hit. You know, so I'm very bullish on the precious metal sector and on commodities. So I think those are going to be outperforming during the next 6, 12, 18 months. So
what do you use to you know, to pick the turns? I mean, that's the biggest thing in the markets is, you know, the turn when things go. So, you know, you can buy options and they can expire worthless and stuff. Do you have, you know, is there a technical level? Is it a gut feeling in your stomach? What do you use to catch the turn?
For those moments when I get speculative, you know, obviously I use a combination of fundamental analysis and technical analysis. You know, if I'm going to be bearish on something, first of all, I mean, for example, in the last few months of 2020, I was very bearish on Tesla as an example. You know, it had a PE ratio of over 1,600 at one point. You know, its RSI was very high. So for me, if I feel that there's underlying fundamental weakness, plus I feel there's an overbought condition, you know, then I will consider them to start putting in, you know, my tone of water for speculative things. So no, I don't use like my gut on these things. Fundamental analysis, when that's in line with the technicals, you know, very bad stocks at very high prices, then I see some bearish opportunities. And of course, the reverse, when I see something that's oversold, you know, and I think it's fundamentally strong, then I start accumulating it. So no, I mean, it's all data driven as far as I'm concerned, and it's worked out well in recent years.
All right, Paul Mladjenovic is the author of Stock Investing for Dummies and also the Raving Capitalist, which is, again, my favorite name ever. Paul, thanks. It's been a while since we spoke. Thanks a lot for the time today.
Thank you. I wish you all success. Thank you again.
Thanks, right, Paul.
Next time we get Paul on, we'll have to do an audio check before.
There's
some audio hiccups there, but
everyone gets.
He's got so much energy, though. I like his energy.
Yeah. All right, 8:45. We're gonna have Blue Putnam, the chief economist of the CME Group, on at 9. In the meantime, I asked Paul that question, and I want to ask it to you guys as well because we got it from chat. But how would you position for a hypothetical? And again, assuming we all can recognize it when it's happening, and it's not just a flash in the pan like last March. How would you position yourselves for one of those long-term downturns?
I already did it
from chat.
I already did it. I did it 2 weeks ago. I started raising cash. I redeployed a little bit of that a couple days ago, but I've still got more cash than I normally have. So I started selling stocks. So you could buy.
Okay, so then let me rephrase. What would you own? What would you own besides cash? Okay, so you would just own cash. Okay.
Yeah, I'm not gonna. I would short stocks. I really thought we were going for a downturn. I short stocks. I don't need to go and buy SQQQ. Like people say, oh yeah, let's get long SQQQ. Well, I guess when you aren't allowed to short stocks in Robinhood, you don't have any other choice. I short the QQQ. If I'm bearish, I don't need the SQQQ. I'll just short the QQQ. That's good enough. So that's how I play it. I short stocks. So, but I'm obviously always long. I'm on my trade. I'm always long short. I'm just trading market neutral. But long-term investment portfolio. The only time I rarely hedge myself. I hedged myself back in February, starting in January of 2020, because I was really worried about COVID. So I bought puts. I bought a lot of puts. And a lot of those first round puts, like I said, expired worthless. And then I reloaded because I was convinced that COVID was going to get ugly. And I was then, obviously my puts paid out for me, and it helped me to hold at least some of my portfolio. But when you get nervous, first thing you do is you raise cash. You sell the stocks that you think are the most exposed. So I was worried in a couple of weeks ago about the SPACs and about the SPACs getting ugly. So I started lightening up my SPACs, and I was also worried about the tech getting ugly. So I started lightening up some of my growth trades, some of those growth names. Didn't sell my Amazon, didn't sell my Apple, didn't sell my Microsoft, didn't sell my long-term Qs holding, didn't sell my long-term SPY holding. Those are long-term holdings that I've had in there forever, and I'm still comfortable holding them. But any of those smaller growth names, I thought the ones were hit. The Cathy stocks, I thought those might get hit, and they did. They bounced back nicely. So that's what the first thing you do. You raise cash.
I think that's a really, really tough and vague question, because we have so many people of different ages, right? In different places. I mean, if you're, I don't know how many people we have like over 70 listening to the show, right? But if you're 70, 75, 80, and you've been in the markets for a long time, and you're living comfortably of, following your game plan, then, you want to leave the chips on the table, fine. But you got to look, if you're a youngster like Spencer or like Mike did, I think you prepare for the downturn by getting ready to buy more. Mm-hmm. I mean, that's, it really depends where you're at. Are your kids need to go to college? I mean, I can remember back in the financial crisis, we had some friends that, oh my gosh, our kids, we had 4 years worth of school, and now we're down to a year and a half. I mean, what things are important to you? Buying a house or, where you're at. So, but it's so hard to time it, like you said, with the puts. The timing of them is really hard.
I remember Dennis was like bashing his head against the wall because he was like, "I can't believe it! I can't believe it!"
Well, it was all February.
Why am I wrong? Why am I wrong?
I couldn't believe that I was wrong.
I don't think I'm wrong.
I was wrong for a month and a half about COVID. The market kept going higher, and I'm like, I'm convinced this is going to get ugly. My timing is just out, and the whole first round, I tried to be a hero and buy 3 weeks out. It wasn't enough. So then I went 4 months out. I was like, it's going to get ugly by June. So I'm like, I'm going way the hell out. And I went way the hell out. And then obviously I bought puts, I think the SPY 328. I think it was. And the SPY was around 333. And I think it was ridiculously cheap. I kept saying how cheap insurance was. I think I paid $3 or $4 for like the 325 puts. And SPY obviously went to 225 or whatever. It went to 230. I got out way before that. I was on the show and I was saying I was lighting up. When we got to like 270, 280, I was like, okay, we just fell 20%. I'm like, I feel like now is the time to start lifting my hedges. And then we kept going down. I was like, why did I lift my hedge? I'm like, I'm getting hammered now too. This is horrible. I called this thing and now I'm losing money too because I left my hedge too early. So anyways, I rarely hedge my long-term portfolio. If you're a long-term investor, you hope the markets go up over the long term, and you continue to accumulate good companies at reasonable prices, you will be fine. Like I said, I rarely hedge my long-term portfolio. There's been, that was one of the only times in the last 10 years. In the financial crisis, I hedged myself too, because I thought that was going to get ugly as well. Sometimes the really serious ones are very obvious too. The financial crisis was slow too, and it was obvious, when it was happening. Like the people got that's like, oh, I didn't see that coming. What do you mean you didn't see it coming? There was like literally so much warning in 2000, 2007.
2007 is when
common.
The housing bubble burst in 7, but the
And
market
the stocks were still holding on.
market didn't crash till 08.
No, I know, really. It started going down late 2007, but yeah, it was.
No.
It gave you lots of warning, and COVID gave you so much warning. Like people were like, "Oh, I didn't see March coming." Well, you definitely didn't listen to pre-market prep. We talked about it for a month and a half, for 6 weeks. People were getting sick of us talking about it.
People were very upset.
They were upset that we kept saying the market was going to go down and it was going up, because it was just, it was ignoring it. We completely ignored what was happening in China. I was like, I see what's going on. I see these videos and stuff. I think they're lying about the numbers. We said it all on the show. And obviously, that was an obvious one. I mean, Chris Camillo, who is the permabull, and obviously heavy, margin buyer and everything, he bought insurance on his portfolio back then. Because I talked to Chris back then, because I couldn't believe. I'm like, and like we talked, like, are we the only people in the whole world who see what the hell's going on? Apparently we were. It was very obvious. That's why, like, even going after, the administration and saying, we're going to go after Congress that knew if you were watching anything on social media, you knew coronavirus was coming. There was no doubt. And there was no doubt it was probably going to get ugly. I didn't foresee a 35% downfall. I thought it was going to be like, maybe going back to SARS where we had a 15% fall. I didn't think we were going to fall 35%. So it got way uglier. But going back to your original question, I rarely hedge my long-term portfolio. I will allocate, if I'm a little nervous, I raise a little more cash.
Yep.
If I'm a little bit aggressive, I put in a little more stock. So I'm just balancing. But I'm probably always holding like half my money in stocks always. Like I'm always long in the long-term investment portfolio. So as the market goes up, if it continues to drift higher, you're going to make money that way.
Frederick Walser says that he called you Chicken Little Triple D, but he did end up buying puts on the cruise line.
He bought puts on the cruise lines. That was a smart move. I had one short, and it was an airline short. It was like UAL.
Yeah,
remember that one, Joel?
Yeah.
I was going on the vacation, and I shorted UAL. Yes, Evil Dennis shorting stocks again. But there was like they announced something. It was like, I don't know, like end of February. And UAL announced they got some perks or some, bonuses, or they announced something that they got some deal or something, with, for like, I don't even know what it was. It was like a credit card deal or something like that. It was something ridiculous.
Okay.
And the stock popped from 75 to 81. I remember that. And I was like, this is the stupidest pop I've ever seen in my entire life. And this was right before I thought Corona was going to get ugly. And I got short UAL like $81 after hours. And then I'm like, screw it. I'm going on vacation. This was a Friday night, and I was going to Jamaica, which was crazy to go to Jamaica when I thought coronavirus was coming. I wanted to bail on the trip. I was like really nervous. I wanted to bail on the trip. And anyways, I was like, I'm just going to hold this UAL short in my overnight portfolio and go to Jamaica. And I went to Jamaica, and I'm watching like the markets crash. That UAL, 2 days later, I covered it like 60. Like it literally went down. It was like an overnight trade, and I covered 60. And obviously, it went down to 20. So I always get out way too soon. But anyways, that was a nerve-wracking trip for me to go on vacation when I knew coronavirus was coming. So it is what it is.
Yep.
All right, S&Ps, we're holding the majority of these gains here. We're up 15 and a quarter handles, 2 points off the high at 90.75. So a good morning here.
Yeah.
Do we cover GE? It's just we did talk a little GE, big news on GE. It's just holding in here at 13.75. That was the area of the two lows from yesterday. So bulls and bears are squaring off there. Did we cover earnings? Did we cover?
There were no earnings. There were no earnings.
I know. It's what about
the SPACs?
Let's talk SPACs. Okay.
Because you know what? the market had a wicked rally. These SPACs are just forgotten now. There was so many SPACs that did not participate. Like, really didn't even go up at all yesterday.
Mm-hmm.
Like, you would have thought that, here's this market, that, everything's ripping higher. And there was a few, not all of them, but there was a lot of SPACs, especially the $10 ones that'll come all the way down to 10. And they are just forgotten. They just are not. They don't get any love. I don't totally understand it. Like I said, I still think there's going to be some good SPACs out there, but the whole SPAC sector is absolutely hated right now. And any deal pops, I've been selling into the deal pops too, but you don't even see them announcing deals right now because it's not the environment to be announcing a hell of a lot of deals.
That's not true. That's not true. There are deals announced every week.
There hasn't been for the last couple of days. I haven't seen any. Like we were seeing 3-4 a day.
Oh,
they slowed down. It's slowed down.
Maybe not every day. But
I think it's slowed down a lot. Maybe it's selective perception on my part, but I think it's slowed down quite a bit. The deal announcements here. I said like I wouldn't be announcing a deal right now. Wait till you have a better environment where they're going to reward you. Because right now you're seeing deals and the stocks are going down. The SPACs are going down on the deals. So, anyways, the SPACs have been like left in the dust here for the most part. A lot of them. Even somebody was asking about the poster child who started it all was CLI. What the hell? Like CCIV, yeah.
Or CCIV. But
I mean, that didn't really go up much yesterday.
Yeah.
I mean, look at it. You saw this rip and rally where they were buying everything tech, and this stock was up. The SPAC was up a little bit. But it didn't rip your face off rally. You would think that would rip to 30 on it, and it didn't. So is this an opportunity for a catch-up trade in the SPACs? What I'm throwing to you, Joel and Spencer.
Yeah,
is this an opportunity for a catch-up trade, or is there a reason they're not participating?
You're talking to the wrong guy. I have.
We gotta get SPAC attacks.
Yeah,
get Chris Cathy on here. Mitch, are you in the background?
I think he is. The weird thing to me is like where is all this money from the SPACs coming from? You know what I mean? Like they're raising all this money from all these investors, just a stupid amount of money. Where is it all coming from? That's what I want to know. Like how much dry powder?
Where does all this come from?
How much dry powder could there really be out there?
There is, though. People are buying digital art for $1 million. I mean, there's a lot of money just looking for a home. People are scared of inflation. They just want to buy whatever they deem an asset, not even assets in itself, whatever they think is an asset. Like, oh, I'll buy a Twitter. I mean, if you're going to pay $2.5 million for a Dorsey to have the rights that I own the first Twitter, I don't even know what the hell you do with that. But, yeah, like this is, you want to talk about selling snake oil. I mean, this NFT stuff just seems like this is, oh yeah, we got the snake oil. We got the good stuff. We got these, we'll give you the rights to the first tweet ever. I mean, this sounds like it's going to end inevitably.
Here. I mean,
they're bidding it up. It's like $2.5 million bid or something for that tweet. It's absurd.
It's
if it's going to be that absurd that you're buying nothingness, I mean, Bitcoin's absurd in itself too. So, you're going to buy nothingness? Well, at least as the stocks, you're getting somethingness. So I can't, see really like, I'm not predicting this epic collapse in stocks. I thought we were overbought. We kind of had a pullback. I'm going to keep reallocating capital on the dips. Today we're getting another rip, but I'm going to keep reallocating capital into stocks because if they're going to just get stupid and pay, real money for a digital art clip that anybody can download for free, you can't be bearish. You can't be bearish stocks.
We'll have to get Blue Putnam's thoughts on what this says about the economy here in a minute. But
before you bring Blue on, someone was asking about the different color candles on the chart, and what you're seeing here with the purple and fuchsia or whatever that color is, that represents the after hours in the pre-market trading. So, and then when you look over to the right, the upper right, the green and red candles are just a regular session. So this is the pre-market prep show. We like to talk about the pre-market action, and a lot of times it's a precursor to the action that you'll see in the regular session.
I'm gonna make a stand here and say that's magenta and cyan is what I'm declaring.
Okay, all right. Yeah.
9 a.m. Let's bring on Blue Putnam, as I mentioned, Managing Director and Chief Economist at the CME Group. Blue, good morning. How are we doing today?
Doing well, thanks.
All right, Blue. I'll pose you the question that I just asked, which is, what is the NFTs and all this? What does it say about the state of our economy right now? How late in the cycle are we?
We're pretty early in the cycle.
Pretty early in the cycle. Okay.
This is not really a cycle. This is a rebound. And so when you think in cycle terms, you get really confused. The pandemic really shut down the economy, and now the vaccine is going to make it possible to be fully reopened. And that's a transition. Cycle thinking is not appropriate here. This is a rebound, and it's pretty big, and you add stimulus to it, so forth.
Okay, Blue, the main reason I asked you on here today is I wanted you to explain to me, like I'm 5, what is going on with the Fed and trying to control the yield curve and that then impacting stocks. Can you explain all that to me, like I'm 5?
Oh, well, we can try.
Okay.
Well, the first thing, let's take it backwards. Let's talk about stocks first.
Sure.
Stocks are, in the terms of a fixed income person, they're long duration assets. That is, particularly tech heavy stocks. They have a duration of like 50 years. The longer the duration of what you have to expect to get your value out of it, the more interest rate sensitive you are, particularly to long-term bond yields, because you match up the maturities to the duration and so forth. So let's just remember that as we go through this, is that the growthier the stock, the more technology growth stocks, you're going to be a lot more sensitive to rising bond yields. Okay, now let's go to the Fed. Actually, before let's go to the Fed, let's go to the stimulus package. We're putting out 1.9 trillion, of which 1.2 trillion is going to be spent in this fiscal year, which ends September 30th. So that's pretty rapid spending, and half of that 1.2 trillion is going to be spent in the next 6 or 8 weeks. Well, spent by the government in the next 6 or 8 weeks. That's the direct payments and unemployment insurance and things like that. It's going to hit discretionary spending very quickly. So the bond market knows that it's got a lot more supply coming than it had expected, because this is a very big package. And now, what is the Fed doing? The Fed is buying $80 billion of treasuries every month. And if you do the math, that's about half of what the Treasury is going to have to borrow just to fund this new package this fiscal year. Forget about the fact that we already had a big budget deficit and they were going to have to borrow a ton. So the Fed is buying securities, but they're buying at the same pace they were last year at the point of the pandemic. And they're not increasing their buying. So the control of the bond market has really shifted away from the Fed and to the market participants who are having to react to all of this supply that's coming. So, we have a lot more supply. There's no extra demand from the Fed. Bond yields have gone up a lot. Bond yields went up a lot. Long duration assets like bonds dropped in price, yields rose, but so did stocks, particularly the technology heavy, growthier stocks that are more longer duration. Maybe that was a high school version.
No, so explain what comes next now. Like what comes next? We saw the market not really react well to what Jerome Powell said, or I guess what he didn't say. Can you explain that reaction? Well,
a lot of the market participants believe the saying that that don't fight the Fed, or the other way of looking at it is the Fed has your back. And they were trying to figure out what Powell was guiding about the future. And Powell's been very, very consistent. The Fed has said, look, we don't care how fast this rebound is. We don't care what kind of inflation comes out of it. We're staying at zero rates for at least another year and into, probably into the next. And by the way, we're going to keep buying 80 billion of treasuries and by the way, also 40 billion of mortgage-backed securities every month, because we'd actually like to see inflation overshoot. And, we're not even convinced a lot of inflation's coming. What we may see in the next couple of months is temporary. I'm quoting Powell here.
Yeah.
And so, he basically said the Fed's going to stay exactly where it is, no change. And then what that told the bond market was, wait a minute, so we market participants have to absorb all this new supply. Oh, well, maybe yields better go up a little bit. So that's what happened in late January and February. It's all anticipatory. We've priced all this in now. I mean, by the time the president signs this bill, all the effects will be done.
And yet, in the last couple of days, though, yields have gone back down.
Well, they
a little bit
within the volatility zone. You guys are way more accurate about these things than I am.
All right, fair enough. Yeah, I mean, it's such a minutia point, right? It's such a short
160s. We're at 155 on the 10-year.
Yeah. Okay. Fair enough.
I feel intense, not hundreds.
So I guess how afraid or not afraid are you of an inflationary environment? Because we see a lot of people always freak out. Oh my gosh, inflation! It's going to be terrible for stocks. How afraid or not afraid? And you just said what Powell said about that, and how they're not really that concerned. A, and B, they're not sure it's going to happen. How concerned or not concerned are you of inflation?
I think we probably will see a little uptick in inflation over the next couple of months, but that's really related to supply chain issues, logistics, problems getting goods shipped around. It's not so much the longer term inflation that the bond market would be worried about. So I'm in Powell's camp there. Longer term, and by longer term, I mean 2024 and further out in the decade, the jury is definitely out. We have tremendous stimulus from fiscal policy, tremendous stimulus from the Fed. So that's what you'd call modern monetary theory, the fusion of fiscal and monetary policy. And a lot of people think that's going to bring some inflation. On the other hand, we are in a technology society that companies can expand production and do so by actually not even raising costs, sometimes lowering costs. Most technology companies and most companies that have harnessed technology can expand their businesses at a pretty stable cost structure. And so that suggests long-term inflation is significantly less likely. And then there's demographics. The U.S., Europe is getting older. China's getting a lot older faster. That means there'll be some pressures on the labor force. And so that does suggest some inflation coming in wages down the decade. So the jury's definitely out on long-term inflation. But look, right now, what do we got? On the 10-year, we're at 155 on the yield. Where are we on core inflation? Historical lagging 12-month lag, we're about 150. What's the premium there? There is no premium. I mean, if you're telling me the bond market's scared of inflation, I got to see the bond market pricing in much higher inflation. Now, TIPS, the 5-year Treasury inflation protected TIPS price in about 2.5% inflation, which is still in the 1 to 3% range we've been in since 1994. So, the jury's still out. I'm not convinced about the long term.
Yeah, we haven't seen inflation really. I mean, kind of in my lifetime. Beyond that, like we just said, we haven't really since when? Like the 70s was the last time we had a prolonged period of inflation?
Yeah, we started to see inflation in the late 60s, coming from a pretty low of 2 or 3% and creeping upwards. By 1971, the president took us off the gold dollar standard. We saw a lot of inflation in the 70s, and we peaked over 10% in 1980, 81. Yeah. And that's when, the bond yields went to 14%, the Fed funds went to 20%. I mean, it was a pretty dicey period. By the way, if you want to look at equities, now not on a daily basis, where a lot of people say equities are a good position to handle inflation, but if you look on a decade by decade basis, when we've had an inflationary decade, equities haven't been all that outstanding. Now, obviously, bonds, that's an even worse story. If you're going to get a lot of inflation, bonds have to price that in, and that's lower prices, higher yields. But, equities aren't that. We hit this is way back, but in the 60s, we hit Dow 1000. We didn't cross Dow 1000 definitively until like 1982, 83. We went and touched it like 4 or 5 times and just couldn't cross it in the 70s. So,
Yeah.
If we have a lot of inflation, then you have to be careful on equities. But by a lot, I mean over 5%. This 2-3% doesn't matter much.
So if you could point to one, what signal are you watching the closest right now? What economic indicator are you most focused on?
Well, I watch about 1,000 of them. But
Right.
if I'm worried about inflation, I'm watching the dollar.
Okay.
Now, go back to the 70s. The dollar was incredibly weak. The U.S. got forced off the dollar gold standard. I mean, it's very hard for a country to have a lot of inflation without also having a weak currency. It creates this, what we used to call a vicious cycle. Inflation comes up, the currency gets weak, it feeds back in. Since the late mid-'80s to now, we've had more or less a virtuous cycle of stable to strong dollar and not much inflation. So I'm looking at I want to see a different path on the dollar. And right now the dollar's fine.
All right. Blue Putnam, Managing Director and Chief Economist at the CME Group. Blue, thanks a lot.
Thank you.
All right. And just to bring the conversation full circle, talking about inflation and the 70s and what we were talking about earlier, who were the biggest beneficiaries of the rip-roaring market in the 80s? It was everyone who just kept on buying and buying and buying all the way through the lost decade of the 70s. And then when the market started ripping higher for 15, 20 years, they had the most capital to compound, right? So just to bring it full circle on long-term investing. And it probably sucked for a decade or more. But once the market turned in the 80s, they were the ones that were best positioned to benefit. So, okay. It is 9:12. That's going to be, I think, a wrap. Joel, do you have any final thoughts? You're still hanging out. Oh, you're on mute, though. Unmute your mic. Or not. Joel, unmute yourself on StreamYard. You're unmuted. You're muted on the bottom there. All right. Well, while Joel does that, I will do a couple of housekeeping items.
Sorry about that, Spencer.
Okay.
Too many browsers open. No, I'm gonna bug out here too. I mean, we got the 38.98.
Okay.
Talked about a target on 1.25 yesterday's high, so we're gonna maybe at this rate we're gonna be there real soon. So we'll keep on that. Looks like another good day so far in the market, and creeping back up into the 3,900 handle, that all-time high 39.57 1/4. It looked pretty far away on Friday. Looking much closer now. So, all right, Spencer. I'll talk to you later on.
All right. Thanks a lot, Joel. Some housekeeping items. I put this up on the screen earlier. For Benzinga Pro, I'll put it up on the screen again here. Go to pro.benzinga.com. If you enter promo code YouTube47, it's right there. YouTube. You can do all lowercase, all capital, whatever. YouTube47. That'll get you 47% off a monthly subscription of Benzinga Pro, as long as you pay that annually, right? So if you pay for a monthly sub, pay for it annually, pay for 12 months upfront, you'll get 47% off with the discount code YouTube47. Again, pro.benzinga.com. I also want to call everyone's attention to the fact that within our description of these videos on YouTube, we got like a ton of links, like a lot of links. There's a link to our free 2-week trial. There's a link to our swag store. You want some Benzinga merch. There's a link to our Discord. There's a link to our newsletters. We have free newsletters and paid newsletters. There's premium newsletters that are about cannabis and investing. And we have free newsletters that are about SPACs and fintech and crypto and pre-market activity. All those links are in the description of all of our videos. I just want to call your attention to that because there's a ton of helpful links there. And within the Benzinga ecosystem, we got a lot more content, not just us talking to you here. We got newsletters, we got pro, we got merch, we got a ton of stuff. Discord. Again, we're on Twitch as well. Twitch and Twitter live streaming all day. That's one continuous stream. This stream will end here in a couple of minutes, and I'll go straight to Get Technical with Neil Hamilton. Programming note for today. I do have my ETF show at 2:30. My guest today is Jamie Wise. You may not know his name, but you know his fund or his ETF, BUZZ, Buzz. The ETF that Dave Portnoy is out there a part of and promoting. Jamie Wise is basically the brains behind that ETF, right? He created the index that ETF tracks. It made its debut last week, got a ton of press. I saw Dave Portnoy making the rounds. I wanted to talk to Jamie because again, he's the brains behind that ETF. So that'll be at 2:30 p.m. Eastern time. My interview with Jamie Wise from Buzz Indexes. As far as the rest of the programming today, we've got pretty much the same deal. We've got training. We got Get Technical after this. We got Benzinga Pro after that. SPACs Attack at 11. Power Hour at noon. My interview, I said at 2:30. First Traded, which is our show that is specifically geared towards people who are total noobs. And if you don't know anything, you don't know where to start, you don't know what half these words mean that we're talking about, watch First Trade. It'll premiere at 3 o'clock Eastern time right here on our YouTube channel. And we've got one of our producers, Rohan, who is a total noob, learning during the show. The entire point of the show is basically to teach Rohan things because he knows nothing. He made his first trade last week. This will be episode 3. And every show, again, it's meant for beginners. If you don't know anything about anything, I highly recommend watching that show. Pre-market prep at the close, 3:30. And, of course, the Benzinga Pro happy hour at 4 o'clock. And then wrapping up the day, we are trying to expand into prime time, into evening programming. We're working on it. We've got the Benzinga After Hours show at 8 p.m. tonight with Ryan Rosebiani, and we're going to do some more stuff. I know Mitch has a really cool show he's been working on. I'm not quite sure the timing of that, whether it's going to be at 5 p.m. or at 6 p.m., but we're definitely trying to expand into the evening hours because let's face it, that's when everyone is home, or at least not working. Most people not working, and we want to do some more evening programs. So we're going to start live at 8 a.m. every day. That's not going to change, but we're going to go longer into the evenings. Still trying to work on that. I've taken your feedback. We are working on a fundamental analysis show as well that should make its debut next week. And any other suggestions for shows, for content, email us. You can send your email to a couple places. Email powerhour@benzinga.com or premarket@benzinga.com. We are open to any show idea, right? We got hours to fill. We're open to your ideas, right? Because the best ideas don't always come from inside the house, right? So email those addresses with any ideas of Jason West says he knows a lot about nothing. And then Jason, First Trade is for you. Okay. That was it as far as my housekeeping for today. Let me check on the Get Technical crew. Let me see if they're live, and I will pass you along to them as we have been doing for the past week or so. This stream will end. It'll redirect you to that stream automatically. And let's wrap it up here. So thanks to our guest, both our guests actually, Blue, Putnam, and Paul Mladjenovic. You can catch this show as a podcast. It is available on all the major podcast platforms: iTunes, Spotify, SoundCloud, TuneIn, etc., etc., etc. If you are listening to the show via podcast, please remember that all the information from our show is meant to be used as informational purposes, not for investing or trading advice. And they are live, I'm told. So I'm going to wrap it up. Everyone, I will see you all in a little over an hour for the Benzinga Pro update. And in the meantime, here is Get Technical with Neil Hamilton.